extremely delighted to have been invited by the Federal Bank today to deliver the KP Hormis Commemorative Lecture. The chairman of the Board of Directors has already introduced and spoken about late Sri KP Hormis, who was the founder of this Federal Bank in 1931. And I would not hesitate for a moment to say that Sri KP Hormis was a great institution builder who recognized quite early in Indian history the critical role of entrepreneurs in an economy. He also realized the importance of banks in providing finance, especially to the micro, small, and medium-sized entrepreneurs, and the need for prudence in banking business to preserve financial stability. 1931 was fairly early days in our journey towards independence and post-independence India. The Reserve Bank was set up in 1935, so this bank predates the establishment of the Reserve Bank of India in 1935. A lot has been said by the chairman and the managing director of the Federal Bank has also explained to me the various initiatives which are being taken by the bank. I had opportunity of seeing some of the new products and new processes, banking processes, which have been launched by the Federal Bank in the pursuit of financial inclusion and taking banks closer to the people. There was a time when we were talking of taking the banks to the doorstep of the people, but I think today the banks are available to people at their, on their fingertips. So that is the progress which we have made in India over the last, several years, with exponential progress being noticed in very recent years. The expectation of all of you today would be that I would talk on the current situation, which I will do towards the end of my talk. But today what I have done is that I have sort of chosen a topic which is primarily focused on G20, the Indian presidency of G20. I will first talk about it and then perhaps try and conclude by saying a few things on what's happening world over today, especially over the last 1 week. Now, despite the multiple and overlapping shocks to the global economy from COVID-19 pandemic, the war in Ukraine, and the synchronized monetary policy tightening by central banks across the world, the Indian economy remains resilient and is expected to be the fastest growing major economy in the world. The National Statistical Organization has projected a growth of 7% for the current year, and for the next year, 6.5%. In the Reserve Bank of India for next year, we have given 6.4%, which is close to 6.5%. But this year, the expectations are that India will record a growth of 7%, and that will be a growth by a major economy at, which will be the highest among the major countries, the major economies in the world. Our financial sector today remains stable. The worst of inflation is behind us, and the Indian rupee has exhibited the least volatility among the peer currencies. As you are aware, India has assumed the G20 presidency for 2023 in a world that is fractured in geopolitics, trade, and supply chains. The Indian presidency is driving home the philosophy of Vasudhaiva Kutumbakam, one earth, one family, one future. The endeavor of the Indian presidency is to realize the potential underlying this philosophy. I have therefore chosen the theme of G20 for a better global economic order during India's presidency for my address today. When we talk about a fractured world which is today prevailing, fractured in terms of geopolitics, in terms of trade, in terms of bilateral relations, in terms of supply chains on the one hand, But on the other hand, we are talking about one future, which means that the focus of the G20 presidency, the focus of India's presidency in G20 is to try and do its best to ensure that all countries move together for a brighter future. As I said a little while ago, India has assumed the leadership of G20 in an environment of formidable geo-economic shifts, which have vitiated the global macro-financial outlook. The capacity of the existing global economic order to manage severe impact of multiple shocks is under challenge. This has led to severe supply-demand imbalances in critical sectors, and this has also given rise to high inflation in almost all countries of the world. Globalization of inflation to multi-decadal high levels and subdued global growth and trade have posed complex policy challenges to almost every country in the world. As the premier forum for promoting cooperative and effective solutions to global problems, the task of the G20 is cut out, given the difficulties in building consensus and the uncertainty around the outlook on geopolitics. The ongoing global crisis is both an opportunity and a major test for the G20, which represents 85% of the world GDP and 75% of global trade. That means if you put the size of the GDP of all these 20 countries, the 20 member countries, and look at their GDP, combined GDP, and also look at their aggregate trade volume, they represent this 85% and 75% respectively, which I just mentioned. Following the East Asian financial crisis of 1997, the G20 was founded in 1999 as a forum for the finance ministers and central bank governors to discuss global issues and policy options. After the global financial crisis of 2008, the G20 was upgraded to the level of heads of states and heads of governments in 2009. In an interconnected world, national policies alone will not be sufficient or effective when the nature of the shocks is global and persistent. Post-COVID, the world economy was recovering gradually on the back of large policy stimulus and rising pace of vaccination when the war in Ukraine led to sharp increase in global food, energy, and commodity prices. It also triggered renewed supply chain disruptions. Geopolitics has now been taken over by geoeconomics. According to the International Monetary Fund, that is the IMF, the global economy is now experiencing a process of key channels, and they are trade, technology, capital flows, labor mobility, and global governance. There are rising restrictions on trade and diffusion of technology, barriers to labor migration, reduced capital flows, and increased uncertainty about global public goods. The interlinkage between geopolitics and economic prospects of nations has become stronger, with each influencing the other. There is now growing trend of friendshoring and onshoring. The focus is now on ensuring food and energy security and on securing strategic minerals, namely lithium, rare earths, copper, zinc, chromium, graphite, etc., which are required for producing batteries, solar panels, and wind turbines. Actually, the backlash against globalization had started even before the pandemic had struck, as globalization created both winners and losers. the international order could not provide cooperative solutions to make the process, that is the process of globalization, win-win for all. This indeed is the biggest challenge for G20 as a multilateral group. Globalization must produce better and more equitable outcomes for all, including the global south. Of the multiple risks facing the world community, the surge in inflation has posed a complex monetary policy dilemma in every economy between raising interest rates enough to tame inflation and at the same time minimizing the growth sacrifice to avoid a hard landing. The aggressive monetary policy tightening by systemic central banks since early 2022 and the consequent appreciation of the US dollar have led to several economies with a high share of external debt becoming highly vulnerable to debt distress. Now, these are countries which have high external debt borrowed from other countries. When dollar appreciates, the local currencies of these countries, naturally, they depreciate compared to the dollar. So the entire repayment burden, the debt burden goes up, leading to debt distress being faced by many of these countries. And I would like to mention that so far as India is concerned, this is something which does not really affect us because our total external debt are within very, very manageable limits as per all international standards and methods of assessment of sustainability of the external debt of a country. According to the IMF, 15% of low-income countries, what are known as LICs, are estimated to be already in debt distress, with an additional 45% at high risk of debt distress. So far as low-income countries are concerned, 15% are already in distress and another 45 are likely to face distress as we go forward. Similarly, so far as emerging market economies, EMEs are concerned, about 25% of them are also at high risk. But India, of course, as I have explained, is not in this category of a country which is in high risk. We are not in high risk so far as this particular point of the burden of external debt suddenly increasing because of the dollar appreciation and the rupee and its effect on the exchange rate of the Indian rupee. Further, capital outflows from emerging market and developing economies due to continued tightening of financial conditions have led to reserve losses. As you know, every country maintains forex reserves. These reserves are maintained in the form of gold. They are also maintained in the form of the forex reserves which are invested in the government securities of other countries, particularly the US, the Euro, and the other countries. We invest our reserves, and many of you would be aware that today, if you measure the size of reserves, India has the 5th highest reserve among all countries in the world. So coming back to where I left, capital flows from emerging market, that is capital outflows from emerging market and developing economies due to continued tightening of financial conditions have led to reserve losses, sharp currency depreciations, and spiraling imported inflation pressures. What we mean by imported inflation pressures is that when you import a lot of items from outside, you import commodities and other items, naturally you are paying for it more in terms of your local currency, so therefore that adds to the price of those items, those commodities in the local market. So therefore, that is, we have also in many countries the issue of the challenge of imported inflation also. In such a situation, addressing the deteriorating debt burden in low and middle income countries and facilitating coordinated debt treatment, debt resolution by official bilateral and private creditors under a multilateral framework has assumed priority under our G20 presidency. Despite the overwhelming concerns a few months back about an imminent recession in the advanced countries in particular, the global economy has in fact exhibited greater resilience, reducing the probability of a hard landing. In other words, reducing the probability of a recession. The expectations are now that if there is recession, it will be a milder recession, maybe for a shorter duration of time compared to what was anticipated or what was projected earlier. So it will be a milder recession or a slowed down growth. The probability of hard landing in the form of a deep recession seems to have abated. Nonetheless, there is a trend decline in global growth. There is also considerable uncertainty about structural shifts taking place in the drivers of inflation, ranging from labor market dynamics to concentration of market power and less efficient supply chains. In parallel, global food and other commodity prices have softened from respective peaks and the supply chains are normalizing, which should help in achieving disinflation. Restoration of a more balanced world economic order is therefore at the forefront of the G20 discussions. India has stressed the importance of creating an inclusive agenda to restore stability and confidence in multilateralism while revitalizing global growth. A fragmented global governance regime, as it prevails today, has also led to under-provisioning of global public goods and erosion of economic welfare. The recent examples are discriminatory access to vaccines during the pandemic and reluctance to ensure universal access to vaccines and technology for life-saving medicines, inadequate provision of finance and access to technology to quicken the pace of green transition in the emerging market economies, and the lack of timely creditor cooperation to address the severe stress facing some of the debt-ridden developing economies, which I just talked about. Recommitting to multilateralism is the need of the hour, and the G20 has a major role in this regard. It is also important that the G20 countries take due notice of people-centric transformative changes taking place in the member countries and adopt them to make the world a better place for all. Now, there are many innovations, there are transformative changes, new policy initiatives being taken by the member countries of the G20. So if we have learnings, if we have experiences, it's desirable that we share those experiences with the rest of the world to ensure that technology, business processes, and the welfare and their welfare effects, they are disseminated and they proliferate and they extend to other countries also. Learning from each other's experience to enhance the quality of life for the common man must be a new dimension to global economic order in the future. I would like to highlight two such key areas under India's G20 presidency. First, digital public infrastructure for financial inclusion, and second, climate change and mitigation for achieving a more inclusive global economic order. Let me first focus on digital public infrastructure for financial inclusion. The G20, through the Global Partnership for Financial Inclusion, GPFI they call it, that is Global Partnership for Financial Inclusion, the G20 through this initiative is facilitating a dialogue on financial inclusion in the global forum. The focus is on unserved and underserved individuals and on micro, small and medium enterprises, that is MSMEs. India is sharing its experience in financial inclusion as well as in the use of digital public infrastructure for achieving the goals of poverty alleviation and economic empowerment of the vulnerable sections of the society. India has been one of the front runners or one of the forerunners in addressing the issue of last mile connectivity by leveraging its world-class digital public infrastructure, which, as you would know, includes the JAM Trinity, that is the Jan Dhan Aadhaar Mobile Trinity, the UPI, the Open Network for Digital Commerce, that is ONDC, and the Account Aggregators Framework. We are also highlighting in the G20 discussions the importance of digital identity, digital payments, and digital consent-based sharing of data in enabling a globally integrated financial inclusion ecosystem. India's rich and successful experience in this area offers fine guidance on pathways to improving the lives of the common man. Not surprisingly, India has been recently chosen as the co-chair of the Global Partnership for Financial Inclusion Working Group along with Italy. Let me now focus on climate change and mitigation. Climate change is no longer a distant threat. It's right here staring at us and is a growing danger with risks for millions of lives and livelihoods around the world. Extreme weather events world over, such as floods, droughts, wildfires, cyclones, etc., can disrupt production and supply chains and create shortages of essential goods and services at any time, anywhere. Such events can create sudden increase in prices leading to inflationary pressures. In addition, climate change can also affect the productivity of sectors that are heavily dependent on nature, such as agriculture. For instance, rising temperatures and changing rainfall patterns are causing lower crop yields and higher prices of food grains in recent years. The physical impact of climate change, such as rise in sea level and increased frequency and intensity of extreme weather events, can damage infrastructure and property, leading to higher costs for businesses and households. All these factors can contribute to higher inflation and lower growth, which can erode the purchasing power of households and businesses. As we all know, such events are becoming more frequent in the recent years. Therefore, it is essential that we take concerted climate action to safeguard the future of our planet and its inhabitants. The G20 countries have a major responsibility in providing leadership for global action on climate change and provision of climate finance, together with transfer of technology to take this agenda forward. In dealing with weather-related disasters, India has made noteworthy progress in its green transition agenda and capacity creation for efficient disaster management. Sharing our experience with other G20 countries could open up scope for collaboration in pursuit of the common goal of a greener global economy. It's noteworthy that India is the highest ranked G20 country according to Climate Change Performance Index 2023 and is also the 5th best performing country globally. Given that India is widely expected to remain as one of the fastest growing economies in the world, our energy demand could rise manifold. The challenge for us is twofold. One, to meet the projected increase in energy demand, and two, to rapidly transition from fossil fuel to renewables. Climate proofing of our infrastructure has also been a priority, more so in view of the large investment in infrastructure which is now being made in recent years. Through global forums such as Coalition for Disaster Resilient Infrastructure, that is CDRI, India is providing leadership to global efforts for addressing these challenges. We live in a world where global macroeconomic and financial outlook may become increasingly uncertain because of climate events, and only a committed global response with a spirit of collaboration can help mitigate the impending risk. In this context, the need for scaling up climate finance for mitigation and adaptation efforts in a balanced manner is well recognized. if we were to meet the ambitious net zero targets. In this endeavor, multilateral development banks have an important role to play. They must evolve to meet the increasing demand for lending resources, providing knowledge support, and catalyze private investment while continuing with their traditional roles of poverty reduction and achieving the Sustainable Development Goals, that is the SDGs. To address these issues, the G20 in our recent meeting, which was held in Bangalore, that is the meeting of the G20 finance ministers and central bank governors. In the recent meeting, the G20 has agreed to set up an expert group to deliberate on strengthening the multilateral development banks like the World Bank and others. As I proceed to conclude, let me state that the recent developments in the United States banking system have brought to the fore the criticality of banking sector regulation and supervision. These are areas which have significant impact on preserving financial stability of every country. More specifically, these developments in the United States, especially over the last 1 week and thereafter, drive home the importance of ensuring prudent asset liability management, robust risk management, and sustainable growth in liabilities and assets, undertaking periodic stress tests, and building up critical buffers for any unanticipated future stress. Now, I have highlighted too many points, so let me read this sentence again so that the point I am able to put across. Now, more specifically, these developments in the banking system in the United States drive home the importance of ensuring, number one, prudent asset liability management, robust risk management, and sustainable growth in liabilities in assets. That means sustainable growth of deposits as well as sustainable growth of credit. Second point, undertaking periodic stress tests and building up capital buffers for any unanticipated stress. They also bring out that cryptocurrencies or assets or the like can be a real danger to banks, whether directly or indirectly. Now, when I mention all these steps, we have been engaging with the banks over the last few years, over the last several years, and I'm happy to report that the way the Indian banking system has evolved and the way it is positioned today, as was mentioned earlier, the Indian banking system continues to be resilient and stable. Now, the Reserve Bank has taken necessary steps in all these areas which I just mentioned. That is the area of risk management, doing stress tests, focusing on asset liability issues. Now, just to give some example, when we see, for example, an excessive growth in deposits or an excessive growth in credit, or in particular an excessive growth of deposits without corresponding increase in credit, then there is a cause of worry. What do you do with that excess deposits which the banks are mobilizing? That is a call which the bank has to take where it wants to deploy its resources, where it wants to invest that money, if it has got liquidity with it, if it has got resources with it, which are far ahead of or far in excess of its credit outflow. There the question of risk management comes in. Every investment, every credit, when it is given out, it should be backed by appropriate risk assessment. Now, I am not going into what happened in the United States in the last 1 week because I don't have insight into all the facts of the case. Many things are appearing in the media. We also get several information from several sources. But really, internally in those banks or internally in the regulators or supervisors, what happens? Obviously, I am not privy to the full information. But looking at the whole thing from outside, all that I want to say is that particularly one of the banks, the deposit growth was excessive, but the credit did not grow correspondingly, and the excess money was invested in certain bonds, both government bonds as well as, other private sector bonds. Now there it is necessary to do a proper risk assessment. These investments were made when the interest rates were low. So therefore it is necessary, again I am saying that I do not know whether this was done or not done in the United States, so I am not commenting on that at all, but this situation needs a careful understanding and introspection, a careful understanding, not introspection, but a careful understanding by every bank. So when you are putting money in certain bonds at very low interest rates, you should do, it is expected that the banks should do proper risk assessment. It would be wrong to expect the interest rates to remain low forever. In fact, for more than 10 years in advanced countries, as you would know, the interest rates were low. It was low for long. But that should not have lulled anybody into the belief. Again, I'm not saying they were lulled into the belief, but you cannot assume that the interest rates will remain low for all times. The interest rates will go up. Naturally, when the inflation goes up, there will be rate hike by the central bank. So therefore, the interest risk, the risks and the likely stress arising out of the interest risks need to be properly assessed, and appropriate stress tests need to be done. In our engagement with the banks over the last few years, we have been driving home this point to all the banks to do internal stress tests, to ensure robust internal risk assessment, risk management, to do very careful and robust asset liability management, and look at all related issues. The Reserve Bank has taken necessary steps in all these areas. For example, I mentioned about the point of building capital buffers for any unanticipated future stress. Those of you who are from the various banks or who are closely observing the financial sector, you will remember that at the height of the pandemic in 2020 and 21, we kept on stressing to all banks, both in our direct communication with them as well as whenever I or any of my senior colleagues, we spoke in the public domain, we kept on highlighting and stressing on the need to build up adequate capital. Because COVID stress, how long it would last, what would be the depth of that, what would be the depth of the impact of the COVID pandemic was not known. It was a complete unknown commodity and unknown animal. So we impressed upon the banks, and I am happy to say that in fact, almost all banks took the message and built up adequate additional capital. We insisted, we nudged the banks to raise additional capital because the outlook is uncertain. In 2020, we didn't know how long the COVID crisis is going to last. And then again, thereafter, the war has started last year. So therefore, capital needs to be built up when the going was good. In 2020, 2021, the liquidity was largely in surplus in India. The interest rates were low. So that was the right time for the banks to build up additional capital as a buffer for any possible future stress. Most of our banks, in fact, I would say almost all banks built up additional capital. They mobilized additional capital. And again, I think together between the Reserve Bank as the regulator and supervisor and the banks and the NBFCs and other entities in the financial sector, together we have ensured that financial sector in India overall remains resilient. When we came out with the COVID-19 resolution framework, that was also well structured in a manner so that this process of resolution does not result in a fresh crisis or in a fresh problem. So the Reserve Bank has taken necessary steps in all these areas. I gave just a couple of examples. The regulation and supervision of the financial sector and regulated entities have been suitably strengthened in the recent years. The regulatory steps include, among other things, the implementation of the leverage ratio in June 2019, large exposure framework in June 2019, guidelines on governance in commercial banks in April 21, guidelines on securitization of standard assets in September 21, scale-based regulatory framework for NBFCs in October 21, revised regulatory framework for microfinance in April 22, revised regulatory framework for urban cooperative banks in July 22, and guidelines on digital lending in September 2022. Simultaneously, the Reserve Bank's supervisory systems have been strengthened significantly in recent years through measures which include a unified and harmonized supervisory approach for commercial banks, NBFCs, and urban cooperative banks. The frequency and intensity of on-site supervisory engagements is now based on size as well as riskiness of the institutions. Off-site supervision has also become more intense and frequent. We have strengthened our engagement with senior management and boards of supervised entities like the banks and NBFCs. The focus is now more on identifying the root cause of vulnerabilities rather than dealing with the symptoms alone. We have also issued revised guidelines on oversight and assurance functions, that is, compliance functions of the financial entities. Use of advanced data analytics is also supplementing our supervisory process. To strengthen cyber resilience, a comprehensive cybersecurity framework for banks together with digital payment security control guidelines have also been issued. We have also established the College of Supervisors and augmented the staff strength significantly in our Department of Supervision and Regulation of the Reserve Bank in recent years. What we have in India today is a well-regulated and well-supervised banking sector. The same would also hold good for the NBFC sector, and also it would hold good in the context of the financial entities which are under RBI's supervisory or regulatory domain. Let me now conclude by stating that India has assumed the G20 presidency at a time when it has once again emerged as the fastest growing major economy in the world. International confidence on India's capacity to contribute constructively to reshape the global order is rising. The risk of a hard landing has dissipated world over, even as the pace of disinflation remains less than desirable. Before the cascading effects of geo-economic fragmentation further dampen the global outlook, rebuilding trust through cooperation and recommitting to multilateral frameworks for addressing critical global challenges has become absolutely essential. And I'm quite optimistic about all these initiatives which are being taken under the G20. For a moment, we should not look at just what difficulties lie ahead of us. We should recognize the difficulties, we should recognize the potential risks, we should recognize the potential challenges, but at the same time, we must commit ourselves, rededicate ourselves to building up adequate buffers, to dealing with those challenges, to provide a better future to all the countries in the world. Every crisis can have a solution when powerful minds come together. As Swami Vivekananda had once said, the powers of the mind are like rays of light dissipated. When they are concentrated, they illuminate. I'll stop